Hey there and welcome to the channel. In today's video, we are going to be looking at my investment portfolio, which today is valued at around $337,000. We're going to start the video off by looking at the progression of the investment portfolio, which I've been tracking since 2018. We are then going to take a look at how much I have in stocks and how much I have in real estate and how much in cash. But those are the only three asset classes that I have in my investment portfolio. We are then going to go over my investment portfolio in detail and look at the key ratios that I track for the portfolio. So let's get started. But like always, I do want to ask you to smash the like button and subscribe to the channel if you haven't already. And also leave me a comment below and let me know where you are on your investment journey and what the size of your investment portfolio is. So let's start off by looking at the progression of my investment portfolio, where I made my first investments in 2018 and the portfolio value was at $37,000 at the end of the year. Then at the end of 2019, it had grown by 71% and was about $64,000. It again saw decent growth in 2020 of about 32%, and the portfolio value was $85,000. The portfolio then took a big jump in 2021, both with inflows and good returns from the raging bull market. And the growth was 136%, and the portfolio went over $200,000 for the first time. The portfolio continued to show decent growth in 2022, and the growth rate was 30% despite a bear market in 2022, where the portfolio ended the year at $262,000. And 2023 has also been a pretty good year with a growth of 29% and a portfolio value of $337,000. Now, as the portfolio hopefully keeps getting larger, the inflows into the portfolio are going to be less and less important. And it's going to be more important for me going forward that the return rates are actually high. And it will definitely be a challenge to keep up the high growth rates for the portfolio. But this number is definitely going to go down as long as the portfolio value keeps on increasing. So here we can see the allocation where I have 218,000 in stocks and 114,000 in real estate and only 4,000 in cash, which is a pretty low number. Now, my emphasis for the last 3 years has really been on stocks, and I'm not allocating a lot of capital towards real estate investing. I do try to keep more than $4,000 in cash in my portfolio, but I've had some good opportunities in the stock market for the last couple of months. And also I've had some personal expenses related to my apartment. So cash is pretty low at the moment. The real estate equity is of course the value of the assets, which are two rental apartments, less the liabilities. And I would never count into my investment portfolio my primary residence. That is only a liability for me. And if I were showing you a video about my total net worth, my primary residence would be in that number, but it doesn't belong in the investment portfolio in my opinion. The stock portfolio is mostly individual stocks, although I do have one ETF and also an investment in the Fundsmith fund, which is managed by Terry Smith. Now, currently, 64% of the portfolio is in stocks, and I think this number is going to keep on increasing as the years go by. And of course, I do want to have as much as I can invested at any time, but I would like to have a bigger cash position to be able to take advantage of opportunities as they come along. Because, like you guys probably know, the opportunities in the stock market they can come and go really quickly. So you have to be able to respond fast and have some cash on hand. So this is the allocation here, 9 stocks in total in the portfolio with Meta being the biggest at 33%. Now I do have to admit that 33% is way too much, but I was able to take advantage of the opportunity when Meta was selling at below 90 in September of 2022. Meta is currently trading at $350, and I was able to put a lot of money to work below 90, so that was a great return for me. Now it is a different story with Baba at 12% of my portfolio and Tencent at 11%. I've invested a couple of times in both Alibaba and Tencent, and unfortunately, those investments haven't been good so far. But I do believe that both companies are still undervalued, so I won't be selling. but I'm not adding to my stake at the moment. And like I've mentioned in other videos, I do admit to making a mistake when buying, especially Alibaba, where I paid way too high of a price. But if you are going to be investing in the stock market, you are going to make mistakes. So that's just a lesson learned for me. Then you have CarGuru, which is 6.7% of my portfolio. And CarGuru is another stock that I invested primarily because it was cheap. But like I've also mentioned in earlier videos, I am shifting my strategy towards more high quality and paying up a little bit more. And when I talk about paying up, I'm talking about maybe enterprise value to free cash of 20 to 25 and not paying like an enterprise value to free cash flow of 10 or 12 or something like that, because usually you don't get high quality companies at such low prices, although it happens. But if you're just going to wait for that, I do believe you will miss out on some good opportunities. Then you have Adobe, which is, in my opinion, a high quality company, and I made a video about that a couple of days ago. You can check that out if you want. But I wasn't able to put a lot of money into Adobe, but they've grown into the position sizing they are today, which is 5.4%. And Evolution is another company that I've been fortunate enough to be able to put a lot of capital into. They are now 14% of my portfolio, my second largest position. And I'm pretty happy with that, seeing that I do believe they have a bright future. Now, it is similar with Fortinet at 8.7%, where I've been able to put a lot of money into Fortinet as well. And I think my average enterprise value to free cash that I paid for Fortinet and Evolution is around 17 or 18, which is a bargain in my opinion for two high quality companies. Now, two companies that I have not yet made a video about are Games Workshop, which is the British company that sells the Warhammer miniatures, and Gravity, the South Korean gaming company. They are the smallest companies in my portfolio, and I took an initial position of about 2 or 2.5% in both companies, and both have grown into their current allocation. Now, hopefully, when I make this video next year, I will have a more balanced portfolio where I do think I have made some mistakes in allocating too much of my portfolio to one or two companies. Now, with Meta, that has obviously worked out so far, but it hasn't worked as well with Alibaba and Tencent. And unfortunately, I don't think I am smart enough to be able to pick 3 or 4 companies and get a good return. I have to diversify, and the ideal number, in my opinion, would be about 15 or 20 companies. Next up, we're going to go over the free cash flow for my portfolio companies and the average weighted total. We are going to be looking at and comparing the 1 year free cash flow growth to the 1 year return, and then the 3 year free cash flow growth to the 3 year return, and the 5 year free cash flow growth to the 5 year return. And I'm going to show you the reason why I track those numbers. I got the idea from François Rochon from his Giverny Capital letter to shareholders, where François has been comparing the growth in earnings for his portfolio with the increase in the market price. And he's been doing this since 1996. And we can see the difference in 1996 was 15%, where his portfolio companies grew their earnings by 14%, and the market price went up by 29%. And if we go to the great financial crisis in 2008, we can see the earnings growth for his portfolio was negative 3%, and the market price went down by 22%, which was a 19% difference. Now, if we fast forward to the year 2022, which are the last numbers that he has published, we can see that his portfolio companies grew their earnings by 5%, but the market prices went down by 20%, which was a difference of 25%. Now, the compounded annual growth rate for the earnings growth of his portfolio companies was 13%, and the market price was 12.4%, which was only a 0.6% difference, which in my opinion is pretty stunning to see and really shows us that everything that matters in the end in the stock market, if you are investing in the long term, is the earnings growth of the companies that you have in your portfolio. Of course, the quality of those earnings does matter, and it does matter at which price you buy them at. But it really shows us what you should be focusing on. Now, if we look at the same metrics for the S&P 500, we can see that the earnings growth was 8.9% on average, and the change in market price was 9%. And there's only a 0.1% difference from 1996 to 2022. So if we go over my portfolio companies, we can see that it says here that Gravity had a 0% free cash flow growth rate, which is not quite right. Their free cash flow growth rate is probably much higher, but I just don't have the numbers for it. So I just put in zero there. And these free cash flow growth numbers are of course per share. So companies that are diluting shareholders will have a lower number here. But we can see some great performance from Games Workshop, Fortinet, and Evolution. Adobe, on the other hand, was relatively flat, but ended the year at negative 4%. Now, CarGurus keeps on growing their free cash at a pretty high clip of 78%, while the Chinese giants Tencent and Baba had a pretty good year, but we are comparing it to a pretty low base, so don't get fooled by these numbers. And the same thing can really be said about Meta, but a free cash flow growth rate of 51% is pretty good. But we have to look out further, preferably to the 5-year free cash flow growth rate. But the average free cash flow growth rate for my portfolio companies was 47%, which I'm pretty happy with. Now, obviously, the return was not in sync with the free cash flow growth rate, where the return was 89%. And these averages are weighted. So with Meta being 33% of my portfolio, it has the biggest weighing in the average of 89%. Now, if we look out to the 3-year free cash flow growth rate, Tencent, Alibaba, and Meta are really not doing a good job. But the average free cash flow growth rate is pretty solid at 20% for the total portfolio. But if you compare the growth rate to the 3-year return, we can see there's a big difference. Unfortunately, this was not my portfolio 3 years ago, so my return is not negative 1% annualized for the last 3 years. Now, the numbers start to align when we zoom out to 5 years, where we can see that the average free cash flow growth rate for the portfolio is 25%, while the 5-year return is 20%. And if we would back this out further, we would probably see the numbers start to get even closer. And if I'm able to have a portfolio of companies that have, on average, a 25% 5-year free cash flow growth rate, I'm pretty certain that I'll be able to get some great returns. Now, this is the last table that we'll be going over today, and we are going to be looking at enterprise value to free cash flow, return on invested capital, return on capital employed, gross margin, operating margin, free cash flow margin, interest coverage, and free cash flow yield. I stole the idea from Terry Smith of Fundsmith, but he also has this table in all of his shareholders' letters, where he compares all of these ratios to the S&P 500 and the FTSE 100. Now, for those of you who don't know, the FTSE 100 is the 100 largest companies in the UK. And as we can see here, Terry's companies are all well above the S&P 500 and the FTSE 100 when it comes to return on capital employed, gross margin, operating margin, cash conversion, and interest cover. Now, Terry also tracks the weighted average free cash flow yield for his portfolio, and the free cash flow yield was 3.2% at the end of 2022 compared to the year-end median of 3.4% for the S&P 500. Now, if we compare that to my portfolio companies, the average free cash flow yield is 7, which is pretty high, and it's a number that I'm happy with because I don't want to have a portfolio that's really overvalued because that is likely to cause bad performance in the future. Now, like you already might know, enterprise to free cash flow is a similar number to the free cash flow yield. There's only a slight difference where free cash flow yield is free cash flow divided by the market cap of the company, and the enterprise value to free cash flow is the enterprise value divided by the free cash flow of the company. But enterprise value is the market cap plus any short-term and long-term debt, and then you deduct the cash. Now, since most of my portfolio companies have really low debt and a lot of cash, their enterprise value is usually lower than the market cap. And if we take a quick look at the enterprise value to free cash, we can see that Adobe is the only company that is really priced high. The other companies are priced pretty fairly, in my opinion. Now, the average return on invested capital is pretty good at 32%. But again, we have companies with really low return on invested capital at 11%, 10%, and 11% for Tencent. And I think it's safe to say, with the emphasis that I now put on return on invested capital and return on capital employed, I would probably not be buying these companies today. Now, the average return on capital employed is 25, which is lower than the average for Terry's portfolio, which was 32. Now, the average gross margin for the portfolio is 70, which is pretty high and is higher than Terry's, which was 65. And the average for the S&P 500 is much lower at 45. So my portfolio companies are doing pretty good when it comes to gross margin. Now, the average operating margin is pretty decent at 30%, and the average free cash flow margin is even higher at 34%. But having a free cash flow margin that is higher than the operating margin tells us that the cash conversion is good for the portfolio companies, which is something that Terry also tracks. Now, finally, I do like to invest in companies that have really low debt, so the interest coverage is 65 compared to the average for the market of 10 and compared to Terry's average of 20. Now, in conclusion, I am pretty happy with my stock portfolio and my investment portfolio overall. But like I mentioned, I am planning on diversifying a little bit more and buying more high quality companies for the portfolio. And hopefully, in about 5 years, I will have all of these numbers higher while making sure that these two numbers don't go too high. But that's it for the video today. I do want to thank you for watching, and I will catch you on the next one.